Joining us now on set, Steve Sosnick, Interactive Brokers Chief Strategist, and also joining us remotely, Keith Buchanan, GLOBALT Investments Senior Portfolio Manager. Keith, I want to start with you, actually. We've been talking about the year that was, and so as we kind of look ahead to 2024, what do you think is sort of the biggest surprise or wild card as we go into next year?
Well, thank you so much for having me. It's good to be back. As we look to 2024, we've focused on a couple of things, actually. The gap between the Fed expectations that they put out in the last, you mentioned dot plots a second ago, the Summer of Economic Projections earlier this month, and where the market is pricing in the Fed will take rates in 2024. There's an 85 basis point gap. And typically when that gap gets that wide, we've seen Chairman Powell push back. You talk about those fun quotes, a lot of those. The most fun we had was him really pushing back, there will be pain, and the Jackson Hole speech, where that gap was wide and he pushed back, trying to reel the market back into where he thought things were projected to go. Now as that gap is back wide again, we've seen a couple of weeks ago, not really a pushback that was received by the market as kind of, moving forward with what the market was expecting. We really feel like there has to be some reconciliation between those two. The Fed expectations, the market's expectations, and risk assets are priced off of both of those, as we both know. So the equity rally that we've enjoyed has been because rates have moved lower. And naturally, the bond market has moved higher because rates have moved lower. And we're really concentrating on that gap and what it means for risk markets going forward in 2024.
Well, I see our guest on set nodding his head, so I want to go to you on this, Steve. What is your take on what the sort of everything rally has meant over the past month and what that means heading into 2024?
Well, thanks for having me, Madison and Julie. Great to be here. But what I was nodding because I wish I could push back and give you some debate with Keith, but he and I seem to have a similar opinion. Basically, the fixed income markets have been ahead of the Fed for quite some time. They'd been predicting rate cuts in 2024, even when the Fed wasn't. And then basically the Fed came out recently and confirmed it in the last dot plot, saying, okay, we acknowledge that you're looking for 3 to 4 rate cuts, and we're looking at 3. We generally agree. So immediately the market said, okay, we're looking for 6 to 7. As Keith was alluding to, it's implausible that you get an economy simultaneously strong enough to give you good earnings growth while still being bad enough to require 6 to 7 rate cuts. Mm-hmm. You got to be careful what we wish for here. And so, if the economy is solid enough that we get the soft landing that equity markets are looking for, well then bond rates have to back up, sort of maybe not back to 5, but probably into the mid to low to mid 4s, let's say. Well, that becomes a headwind for stocks. If we get the 6 or 7 rate cuts, well, that's not good for anybody because that means the economy is probably in a bit of free fall. So we really have to resolve. In the meantime, right now, end of year is in play. The everything rally's in play, and right now, for the last 2 months, you pretty much could have just closed your eyes, bought anything, and it would have worked for you.
So, which you got people like you never like to hear, because then what are you for if you can just close your eyes and buy everything? What are you for? You know what I'm saying? Like, you want to be able to gain an edge here. So, Keith, going into next year, how do people gain an edge? What is going to outperform here in this sort of, gap environment, as you talked about?
Well, I'm glad you asked that, Julie, because that's why we earn a fee. We feel like financial, particularly in the banks, the banking sector, there's some opportunities that have arisen because of the rate environment that has really taken hold the last 2.5 months. If 2022 was in a nutshell, we'd say that was the year that the market was trying to catch up with the Fed moving higher. 2023 was the market catching up with just how much higher for how much longer. 2024 seems like higher for longer turned to higher for not much longer. And we're looking for the different parts of the market that really haven't started to price that out in the most specific ways. And financials, even though they have run, the low-hanging fruit seems to have been harvested. But looking forward, price tangible book at this point in the economic cycle really isn't to where it has been historically. There's still a discount that's been priced in. Now, some of that's commercial real estate, which is largely held by some the regional banks, and it has a little more exposure there. But as we look past last spring, the deposit lessons learned, liquidity lessons learned, as well as some names picked up really good assets at really cheap prices, given the turmoil from last spring. So we're looking selectively, but warming up to what the financials and particularly the banks can offer, especially when you look up at the market cap scale to some of the bulge bracket banks.
Keith, I love the way you kind of described all of those different soft landing scenarios, because as you say in your note, the whipsawing of this market is not necessarily a good thing. So Steve, I want to go to you on this, because earlier I asked you this question. Who is smarter right now, the bond market or the stock market? And what does that tell us about the landing?
This is the tricky part. For years, I've always said when the stock market and the bond market disagree about the economy, trust the bond market. Problem is the bond market got it much worse than the stock market this year. The stock market really did get it right in looking for a decent economy, and that's what we got. The GDP numbers have been solid all along. We've been, consumers are continuing to spend. Companies, for the most part, are making good money. Whereas the bond market has had this massive inversion. It's not as massive now as it was before, but it's still. 2-year yields are still 40 basis points, give or take, above 10-year yields, which is, by historical standards, a quite dire prediction. And as Keith and I both mentioned, 6 to 7 rate cuts priced in as a pretty dire prediction. So, first of all, I'm hoping the stock market got it right, because I really don't. None of us are rooting for catastrophe, and so. I don't know, because I think the bond market, which had been the more reliable economic barometer for so many years, decades, it kind of didn't work last year. And so it's your guess is as good as mine, I guess, at this point, right? They couldn't give bonds away at 5%, and now you can't get enough of them at 385, 390. Who's rational there?
I mean, so Keith, that sort of calls into relief the big lessons, as you said, lessons learned of this year, when so many folks had so much trouble predicting what ended up happening. So as we look into next year and try to figure out what's going to happen, how do you sort of key off what we have seen? And how do you avoid the sort of historical bias now of just assuming that maybe the economy is going to be stronger because it was stronger this year when nobody thought it was going to be?
So I hate to keep agreeing with Steve, but we keep going back and forth on different points that have been made. I'll just juxtapose one that was mentioned. As we look back to 2023 and 2022 especially, as rates start to move higher, we had this within the marketplace, this angst that inflation was out of control. The Fed was going to have to put the economy into recession in order to control it. Let's not, don't own any risk assets. That was 2022 in a nutshell. As we move forward to now, we had the bond vigilantes came out and really flexed their muscles a couple of months ago. And the big question was, how contain is inflation? What does the Fed have to do to contain it? Our fiscal situation is from a debt to GDP standpoint, is getting to a level that causes concern, as well as, from a fiscal standpoint, we just can't agree to anything on Capitol Hill to get any solutions that could possibly rein in our fiscal, deficits and then the debt as a result. Those last couple of issues still aren't resolved. And we had inflation seemed like it's headed a trajectory that's sustainable and positive, but really we're still, the last mile is still right in front of us, getting back to 2%. So it was, I think the positioning of the market dictated a lot of the violence of the move. There's never been shorts on treasuries the way there were a couple of months ago that shifted back in a very violent way. I think you saw a relatively similar effect in equities. So the last couple of months or so, we want to make sure we keep that in the context of what's going on and the cause and effect and what's really materially changed in order to cause the type of shift we've seen in risk asset prices.
Right, and it's never good when the Fed and the market seem to disagree moving forward. So we're going to have to bring smart folks like you on again to continue the conversation. Keith, thank you so much. That was Keith Buchanan, GLOBALT Investments Senior Portfolio Manager, and of course our own Steve Sosnick, who we're going to have back on set for Goodbye or Goodbye in a little bit. Thank you both.